To celebrate the launch of Betashares' latest geared global ETF, we're comparing two of the most common ways investors can achieve global diversification. Welcome to Equity Mates Investing, a podcast where we explore what is possible in the world of investing. If you've just joined us for the very first time, a huge welcome to our community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm good, Bryce. Very excited for this episode. We love new products coming to market to increase accessibility for us, everyday investors. We particularly love it when those new products have a bit of leverage baked into them.
We do. Well, today's episode, as we said at the top, is in celebration of Betashares' latest ETF. It's the Betashares Wealth Builder Global Shares Geared 30 to 40% LVR Complex ETF.
Okay, let's just pause there and say we're just going to use the ticker from now on because I don't want you to have to read that out every time.
Thank you.
So the ticker is GGBL.
Yep.
That's what we're going to call it from now on.
Locked in.
Investing globally has never been easier.
So easy.
I remember back when we started, it was a very limited choice in terms of ETFs. There was even, this is showing my age, there was even a listed investment company whose whole purpose was just to own Berkshire Hathaway shares, and it was listed in Australia, so Australian investors could own Berkshire Hathaway.
Yeah.
That was the lengths we had to go to invest globally. Now we can invest in thousands of companies globally from the palm of our hand while sitting on our couch. But with all this choice, I guess, comes the need to be able to navigate it well and to understand all the different options out there. And that's what we want to tackle in today's episode. You're a bit distracted there. Are you looking up this Berkshire product?
I am, yes.
Does it still exist?
It does still exist. It's the Global Masters Fund, ticker GFL. Back in the day, you're right, it gave exposure to Berkshire. It's gone pretty crap. It's down 0.5% year to date. We know Berkshire's up, I don't know, probably close to 20% year to date.
Berkshire up 11% year to date.
11% year to date. To be fair, I haven't looked at the underlying holdings. It could have changed. Oh no, our principal stake is Berkshire Hathaway. That, my friends, is the perfect illustration of listed investment companies and why they are often... Anyway, we're here to talk about index products.
Look, okay.
But we'll rant about LICs later.
You've done it before, you'll do it again.
Yeah.
But we're here to talk ETFs because ETFs have made investing globally easier.
Yes.
And they've also made investing at the correct net asset value of the underlying investments easier as well. ETFs are a better mousetrap compared to listed investment companies.
Yep.
But we're here to talk about investing globally because it is one of the most common questions we get here at Equity Mates.
Should I be thinking about selling everything to simplify to an Australian domicile global ETF?
I'm looking for an all-in-one ETF for my wife just to set and forget.
Recently I've been thinking, should I diversify into something that's a little more all-world?
Love that. Questions galore, Ren. Keep them coming. equitymates.com/contact. We will answer all of those questions in this episode.
Yeah, and if you want us to answer your question, we do prefer you leave it as a voice note so we can chop it up into a montage just like that. So, I guess in this episode, we're going to talk about why diversification matters, and then we're going to compare the pair. We're going to look at the two most common ways you can get global diversification from the comfort of your couch on the ASX. And then we're going to talk about leverage because it is no longer just the domain of the property investor.
Yeah.
There is now leverage available for us in the share market, and we're going to talk about how you can think about that in the context of your portfolio.
Yeah.
But let's start by answering the question, why should we even care about global diversification?
Well, Ren, there's a big opportunity set out there, and if you're just focused on investing here in Australia, you're missing out. The Australian stock market is only 2% or thereabouts of the global stock market. 98% of other opportunities out there, and if you're just investing here, then you are missing out. The majority of opportunities are overseas. And so if you're not diversified, I mean, you're missing out.
Yeah, I think
that's the crux of it.
Take your investor hat off and just put your consumer hat on and just think about the brands and products that you deal with on a day-to-day basis. Like the majority of them are global brands. The majority of products that you're excited to buy, I would hazard a guess, are not being made here in Australia. So it's just thinking about aligning your investing with your consumption in some ways, because you can do that and you should.
Yeah, you should. You definitely should.
The final point is Australia is overweight a couple of sectors, banks and miners. You hear that complaint all the time. And so if you're not globally diversified, you also then end up being quite undiversified when it comes to sectors as well. And so if you want to make sure you've got, like some consumer staples giants and some technology giants in there to really like balance out the giant banks and the giant miners that we have here in Australia.
Yeah. So as we teed it up at the top, ETFs now make it incredibly easy to get global diversification from the ASX. Listed here in Australia, you don't need to worry about other markets and other exchanges. In fact, Ren, we could say it might be too easy. There are now plenty of options out there that give you global diversification, or that you can create the diversification yourself.
Yeah. Australia isn't quite at the point of America, but
No.
2025 will be a landmark year in the development of ETFs. It is the first year that there are more ETFs listed than individual shares.
Yeah, it's crazy.
Yeah.
Overwhelming.
And so, like you often hear that choice is a tax. Like consumers don't want an overwhelming amount of choice. They want sort of curated choices that make it sort of easy to buy the product that suits their desires.
Yeah.
And I think we're finding that ETFs, there's so much choice in ETFs that it becomes overwhelming.
Yeah.
So we really want to simplify it today. And when it comes to global investing and the ETF choices, I think there's two main buckets that global products fall into. The first is a global index, and then the second is the all-in-one diversified ETF.
Yep.
And so we want to step through each of them today.
So we're going to compare the pair using two examples. First, for the global index ETF, we're going to be using BGBL, Betashares Global Shares ETF. The ticker is BGBL. And we're going to compare that with one that was often mentioned in that montage, DHHF, Betashares Diversified All Growth ETF, which is the ETF of ETFs.
Now, a nod to the conversation we'll have a little bit later in this episode. Each of those products have a leveraged version.
Yep.
BGBL becomes GGBL and DHHF becomes GHHF.
Geared.
The G stands for gearing, but we'll just put a pin in the leverage because we'll get to that later. So let's compare the pair. Let's start with what they are, and that will sort of illustrate how they're different. So starting with the global index ETF, it is a global but market cap weighted index. It takes a list of about 1,300 companies from 20 developed markets, not Australia, importantly, and literally just ranks all the companies. Biggest companies at the top, all the way down, and says the size of the company is relative to their weighting. Yep. So like the biggest company is the biggest weighting, second biggest weighting, all the way down. It's the classic market cap weighted index that we're familiar with from an ASX 200 or an S&P 500.
Yep.
That's the global index, that's BGBL. That's different to the all-in-one diversified ETF, DHHF, where think of it like an ETF of ETFs almost. You get a pre-mixed investment that uses a blend of ETFs to provide exposure to around 8,000 stocks in this case, which has some rules around asset allocation, which the ETF sticks to.
Yeah.
And so it will have sort of targets for how much Australian exposure, how much US exposure, and as things move, it will rebalance over time.
Yeah.
So it's a bit more of like a portfolio solution.
Yeah.
Whereas the global index is just like whatever the size, like however these companies move is how we will set the market cap weighted index.
Yeah. So both are great options. If you're just starting out, you don't have to pick stocks for either of them. The internal mechanisms of both ETFs mean that you just have to invest in it and you'll get global exposure. Let's have a look at the underlying holdings though, Ren, because they do differ. In terms of BGBL, you've got individual companies, as you said, top 10, NVIDIA, Microsoft, Apple, Amazon, Meta, Broadcom, Alphabet, Tesla, and JP Morgan Chase. No surprises, you're getting the top largest companies from the 20 developed markets. But that is different to DHHF, which is made up of funds, as Ren said. So your top holding is an Australian equities holding, 37% of the fund is in Australian equities. Now, what you'll find is that then gives you exposure to Aussie companies. 41% is a US equities holding, 16% is developed markets ex the US, and then 6% is emerging markets. So 4 funds there that make up the entire ETF.
Yeah. Now, that leads to some of the key differences between the two. So if you're thinking what's the right way to get global exposure for me, these are some of the key considerations for you. The first one is Australia.
Yeah.
So DHHF, these all-in-one ETFs, they'll have Australian exposure. So DHHF is 37% of the ETF, at least at the time of recording, whereas the global index is ex-Australia, so 0% Australia. So you've got to think, really the global index product is designed to sit alongside like A200 or another Australian shares ETF. So that's an important consideration when choosing which one is right for you. Another important consideration is emerging markets. So the global index product has no emerging markets. It's just an index of developed countries, whereas DHHF specifically has some emerging markets exposure, 6.5%. But I would say probably the biggest difference to think about when you're trying to think about long-term, what do I want as my global exposure, is the US side of it.
Yeah, so BGBL has 74% of the ETF exposed to the US.
And that is purely a function of how the global index looks today.
Exactly.
It's just because the US is dominant, big tech is dominant.
Yeah.
In 30 years, if China rises, if India rises, if US companies get smaller relative to some of these other parts of the world, then that 74% will drop.
Yeah, and you're going to get true global index exposure as those companies change.
Yeah, it captures the growth wherever it comes from,
regardless.
Except Australia, because Australia is
developed
excluded.
markets.
Yeah, but in theory, if the US has another decade or two of dominance, Nvidia goes from 4 trillion to 8 trillion, then in theory, this global index could become even more US centric.
Absolutely.
So that's the design of that product.
Whereas on the side of DHHF, 41% of the ETF is in US, but that is a preset allocation. And so, you know, you even think about the Australian allocation there at roughly 37% or thereabouts. Even if the Aussie market did poorly and just struggled for a decade, you're still going to get allocation to about that 40% or whatever the preset allocation is. Whereas in the global, just pure listing, you're just going to get the companies that come through and are performing at the top, and those that aren't performing so well falling back out.
Yeah. So in the case of Nvidia going from a $4 trillion company to an $8 trillion company, it's not like this 41% US exposure becomes more and more.
Exactly.
Instead, it'll grow, and then each quarter when it gets rebalanced, it'll get trimmed back to the set portfolio weightings that the ETF issuer has set. So there's no right or wrong. We'll sort of talk to how you could think about each, but I think that's a really important way to think about the difference between these two products, which nominally, if you're just looking at the labels, you might think they're similar, but this is a key difference in the way they give you global exposure.
Yeah. Now, a few of the administrative things, management fee, BGBL is 0.08% and DHHF 0.19%. A little bit more work goes into managing DHHF. Now, they do have the geared options for each. So GGBL is 0.35%. And so is GHHF. The reason you're paying more is because you have leverage in there and it costs money to set up in geared leverage.
Well, yeah,
internally.
that you've got to pay interest in the bank
pay
for
your
the
interest.
borrowing.
That's right.
But I would hazard a guess that Betashares get a far better interest rate than we get.
Absolutely. Now, in terms of rebalancing, BGBL is rebalanced quarterly to match the global index. There's no specific asset allocation rules, whereas DHHF is rebalanced quarterly to match the asset allocation that we spoke about, 37% Oz, 63% global.
Yeah.
And then finally, Ren, who is it right for?
Yeah, so I think we've tried to explain how each of these products differ, but people want the answer. People want, well, which one should I be investing in? So they're both good products that suit certain types of investors.
Yep.
I want to start with DHHF. For me, DHHF is a great product if you're just looking for one core ETF.
Yeah.
If you're like, I just want one thing that I can dollar cost average into and I can get on and do more interesting things in my life. I'm sick of listening to these equity mates guys. Just give me one ETF. For me, DHHF is the product.
Yeah. I would say GHHF is the product for me.
Well, we'll talk about leverage later, but
yes.
Yeah. Then I think the global index is if you want to build a core portfolio of more than one ETF. I think if you want to pair A200 with the global ETF, then I think you could just do that. In my personal opinion, I would then think I would want some, maybe like upweight a bit of Europe or Asia because
you're still so heavily long US.
Yeah. Then I think if you want to build a portfolio of ETFs, I think the global index makes sense. You obviously want to pair it with an Australian ETF, so you have some Australian exposure. You may also want to think about some smaller holdings, with Europe and Asia to upweight them. But the global index is like, that's true index investing, where whichever company, wherever the growth comes from, you capture it in the index.
Yeah.
But it is just so heavily US dominated that the US is going to dominate your returns for a little while.
Yeah.
So Bryce, at this point, we've compared the pair. We've looked at what a global index offers versus an all-in-one global ETF, how they're different, how they're constructed differently, and how they can fit in portfolios differently. We're going to take a quick break, and on the other side, we're going to add the spicy bit. We're going to talk about the leveraged options which are coming to market.
That's it. This episode is sponsored by Betashares in celebration of their launch of GGBL, the newest addition to its Wealth Builder range of ETFs.
GGBL is designed to help investors access the benefits of gearing as part of their long-term wealth creation strategy. By borrowing at institutional rates that are typically much lower than those available to individual investors, GGBL provides cost-effective access to geared investing.
The fund offers moderately geared exposure to a globally diversified portfolio of around 1,300 companies across more than 20 developed markets, excluding Australia.
Head to betashares.com to find out more, and a massive thank you to Betashares for sponsoring this episode and helping us keep all of our content free.
So, Ren, you teased it before the break. We want to add some spice to our index portfolio.
Yeah, we want to add some spice. You've been spicing your portfolio for a while
I have been, yeah. Well, the products that I use in my core portfolio are geared. They have leverage, and I've been a big fan of them for a long time now. And I think we're starting to see a lot more retail investors turn to gearing because of the long-term benefits. And of course, products are following. We know DHHF now has a geared version, GHHF. And of course, we've just seen BGBL now have a geared version as well. So the excitement levels are there for a bit of spice.
The excitement levels are there for a bit of spice. And I think the starting point for us is the excitement levels for a bit of spice, for a lot of spice, have been there for decades when it comes to property.
Yeah.
Australians love leverage.
Absolutely.
They just don't think about it in the share market context. Like the latest government policy allows you to put a 5% deposit down and borrow the remaining 95%. The government encourages us to gear ourselves up to the eyeballs when it comes to property. It's just never really been something that's been discussed in shares.
Yeah.
Let's start explaining leverage in the context of property, given it's an example that a lot of people are familiar with. So under the new government scheme, you can get a 5% deposit. So let's say you put a $50,000 deposit down for $1 million property. Then if the property goes up 5%, so to $1.05 million, overall the asset's gone up 5%, but your return on equity, the return on the money that you've invested, was 100% because you've invested $50,000 and you've made $50,000. Now, when we're talking about leverage in ETFs, it's nowhere near that spicy. It's nowhere near that leveraged. But the principles are still the same.
Unfortunately.
I think there is the appropriate level of gearing. So what you need to know here for people who are new to this term of leverage or gearing is for each, in this case, the GGBL product we're talking about is between 30 and 40% geared. For each dollar that you invest, Betashares as the product issuer will go out and borrow, between 30 and 40 cents and put it in your portfolio.
Yep.
And so you're getting an extra kicker on the returns or on the fall.
Yes,
it works both ways. You got to remember that.
Yeah.
But that is really the principle that we're talking about.
Yeah.
And we've got a couple of questions that have come through from the community about geared products that we think will help us explain how you can think about it, and then a bit more about how the underlying ETF is constructed. Let's start with this question from Robert.
I'm just getting started on my ETF journey, and I'm just trying to choose between which ETFs to invest in on the basis that the market goes up in the long term over time, and I want to remain invested over the long term. Isn't it just a no-brainer to invest in a geared ETF or a range of geared ETFs that amplify those market returns over time?
Well, thank you, Robert, for the question, and your words, not ours, no-brainer.
I may have said it off air, but yes.
So look, I think when you start to think about leveraged products, the starting point for me is when we think about leverage in property and leverage in shares, we think about them very differently.
Yeah.
You know, these days with this new government policy, you know, you can buy a house with 95% leverage, 5% deposit, but any leverage in the share market is seen as taboo. To Robert's point around like the long-term trend of the share market, if you look between June 2015 and June 2025, Sydney house prices were up about 70%. Across Australia, it was a bit less than 70%. Brisbane and Adelaide more than doubled in that time. Pretty nuts returns from housing. The global share market delivered 172% in that time before dividends.
Bang.
The share market
No
grows.
brainer.
The share market grows faster than property.
Yeah.
But why property has been such a powerful wealth building tool is leverage.
Yeah.
And like the worked example that you could use is these days with a 5% deposit, you could put $50,000 down for $1 million house in Sydney. If that grows 5%, your return on equity, the return on the money that you've invested is 100%,
Yeah.
50,000 and you've made 50,000.
Yeah.
Leverage is this real power when it comes to property investing that we don't use in the share market.
Well, that is less common in the share market.
Yeah. Or
Because
is
I
seen
think-
as taboo.
People just freak out about it. It's like, I'm going to take out $1 million and put it all into one single asset and get no diversification whatsoever, and I'm comfortable with that. Yet if I'm going to try and put 50 grand in and leverage that to even an LVR of, 40%, I'm going to freak out.
Yeah.
It's like the perception of leverage in the stock market is crazy. But the good thing is there are now products that are coming to market that give you moderate gearing that allow you to take advantage of the long-term returns of the stock market in a well-diversified product.
Yeah, and I think that moderate point is important. If you want some leverage, you don't want too much because your returns are amplified on the way up, but also amplified on the way down. But yeah, over the long term, as markets trend upwards, if you have, I guess, the risk appetite to amplify both the returns and the falls, because the market over the long term trends upwards, your returns over the long term trend are amplified as well.
So we're talking long-term here, Ren, but a common misconception that we get is that a lot of these geared ETFs are best for the short term, and this is a question that's come from Nico.
Hey folks, let's talk leverage. What's your view on geared index funds? Let's say an S&P 500 or an ASX 200 or something similar, low fees, broad-based ETFs, as part of your core or bottom draw portfolio. This is to sit alongside the rest of non-geared ETFs within the core portfolio, or maybe even inside super. I've heard at times the story that geared or leverage ETFs are only beneficial to use in the very short term, but I've also read about strategy I mentioned, holding them long term. What's your thoughts? What should we take in consideration? Thank you.
Thanks for the question, Nico. Look, there are ETFs that are leveraged that are advertised to be short term.
Yeah.
And they are something that we just do not recommend getting involved in whatsoever.
Yeah, they are generally synthetic ETFs that will use derivatives or CFDs, different products to try and amplify the daily movements of the share market. And if you do try and hold them long term, you can sometimes get into
a world of trouble.
Just like, no, not a world of trouble. It's just the returns of the share market and the returns of the ETF can diverge over the long term because they are designed to track day-to-day movements.
Yeah.
It's important to stress that the product we're talking about here, well, actually the whole Betashares range of wealth builder ETFs are not using these synthetic products.
Yeah.
They literally go and borrow money. And so let's say it's a 30% gearing. Every dollar you put in, they put your dollar into the ETF, but they also go and borrow 30 cents and they put that in for you as well. When you go under the hood and you look at the ETF that you want to buy, if you see that it's constructed with synthetics and derivatives, you should be thinking about that as a short-term product. If you see that it's used with actual borrowed money just to leverage your returns, then you can start to think about, well, if it's got a crazy level of gearing, you still probably don't want to think about that long term. But if it's got a moderate level of gearing, that's more of an appropriate option for the long term.
I think it just comes down to what we talk about bottom drawer ETFs all the time. If it's index based, if it's low cost, if you don't have to, it's not actively managed like these are, then having gearing on that is a long term sensible solution.
As long as there's a moderate level of gearing.
Yeah, moderate. Yeah. But like you need to first answer, is the product itself right for long term?
Yeah.
And then the moderate on top, for me personally, is what I like to see in my portfolio.
Yeah. So look, like we're couching all this in general terms and personal terms because it's important to stress that you can build all the wealth you need in the stock market without leverage. Long-term, dollar-cost averaging, sensible investing will get you there. Importantly, we say all the wealth you need to be comfortable and have choice in your life, financial flexibility, have a retirement. That's different to all the wealth you want. Like you may not be buying Lambos and the like, but or you don't need leverage. That's really important to stress. But if you want leverage, some of these new products coming to market we think are great to give people choice, to let people take more control, and to start to balance the absolute inequity that is in Australia, where you can leverage up to the eyeballs. The government encourages you to do that for property, and yet traditionally there hasn't been any choices for shares. Yeah. So in that sense, because there are sensible leverage options coming to market, that gets us excited, and it certainly forms part of our personal portfolios.
Well, Ren, that brings us to the end of today's episode. A massive thank you to Betashares, and a reminder that gearing magnifies gains and losses and may not be a suitable strategy for all investors.
Betashares Capital Limited is the issuer. Read the PDS and TMD at betashares.com.au to see if the product is right for you. Investing involves risk.
Equity Mates Media Proprietary Limited is part of the Betashares Group. And Ren, that does it for today. We'll pick it up next week.
Sounds good.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.